It should be a really interesting conversation with Magoo, who I've gotten to know a little bit via DM over the last couple of months. And I think similarly in a lot of ways, but I don't know him. So this would be a good way for the two of us to get to know each other. My name is Michael Guyot, publisher of the Lead Lag Report. Joining us for the hour here is Magoo. Magoo, for those who are not familiar with you, I know you want to stay anonymous, but to the extent that you're comfortable, just introduce yourself. Who are you? How'd you get interested in markets? Why Bitcoin in particular? And what do you do now?
Yeah, for sure. So by trade, I'm a software engineer. I've kind of been in that space for 15 years and work specifically in the digital asset space, specifically the Bitcoin space as well, for a financial company dealing directly with Bitcoin. But originally what got me into markets was like probably my family. My family's pretty adamant, like financial family, where everyone in my family is in the financial industry. And so just from a young age, I was exposed to it and kind of morphed into me kind of liking to dabble in macroeconomics and just markets in general.
So I think you and I have that in common, sort of growing up and having our parents be in the industry. Now, I'm curious, as you were a young kid, what kinds of things did you hear your parents talking about when it came to the investment industry? What did you learn from your own upbringing in hearing them talk about markets and investing in general?
Well, the very first thing that I learned is that the people, this isn't really market related, but the people that actually have the least amount of money are the most concerned about their money. You could probably take a stab at where at least one of my family members, what kind of industry they work in, but that's kind of one of the earliest memories I have. But other than that, I guess like when it comes to the market, some of the things that my earliest memories learning from my family was basically probably about risk management. I think that was always a big talking point around the kitchen table.
Yeah, and risk management's thrown around a lot, and you and I both know there's all kinds of different risks, and of course, time frames are a function of that. I always go back to the ultimate risk is risk of ruin, right? Which is where you get wiped out. You can be down hard, but getting wiped out kicks you out of the game entirely. How do you think about risk in a world where we have to take some degree of risk because policymakers are inherently trying to inflate away whatever money we've accumulated that we hope would be risk free, but in reality isn't?
Yeah. So we're in this kind of modern monetary or Keynesian world where if you just hold on to money, well, it kind of gets diminished every single day, every single year. And so you're having to go out on the risk curve and venture out somewhere to kind of get your returns that kind of keeps you ahead of the curve, so to speak. So I guess in that sense, like the risk management is like exactly what you said, right? Like trying to stay ahead of inflation by also not blowing yourself up, right? And so however everyone actually has different risk tolerances and they have different ways at managing risk. Some people just like to just talk about investing in the stock market. Some people like essentially just want to have a very diversified portfolio so that their portfolio can withstand any type of, I'll call it, friction in the markets. And other people, they'll throw what we like to call shit at the wall, and like in the VC world where they're looking for those 100 bangers or those 1,000 bangers. And they don't care if 80 or 90% of the things that they throw at the wall don't stick, because the ones that do stick will kind of make up for the ones that don't stick.
Yeah, and actually that point of VC is it's interesting to even apply that to the cryptocurrency space, right? Because when money is cheap and largely free, there's a lot of VC firms that are flush with capital that, will just throw money at ideas, whether or not there's something truly there, or even if there is something there, that there's the ability to execute on that. Take us back to the lead up to the peak in a lot of these cryptocurrency projects last year. I had seen on Twitter myself that, and I'd seen even a lot of people saying this, that in the VC space, as they were looking at blockchain and cryptocurrencies, it seemed like there was so much money floating around that literally anybody and everybody could get some kind of funding, even if it was not really something that was real. Just talk about sort of the lead up to the conditions of the winter that everyone talks about that we're here now, because I think it's important for people to understand how cycles in VC risk-seeking behavior impacts kind of newer technologies.
Yeah, for sure. So usually that comes with whatever you want to call it, riskier technologies or just innovation, right? You see this massive speculative wave that comes in. And that kind of what allows the initial investments to come in and kind of finance the industry or the innovation, right? But you always see like human psychology, everyone always gets ahead of themselves, and they're like, this is a paradigm shift, this is that, and they're just willing to throw endless amounts of money at anything, right? Especially when you're in a monetary environment where the Fed is just endlessly printing, right? Is where we were in this last crypto bull cycle, or the everything cycle, I'll call it. But leading up specifically to in the Bitcoin and the crypto space, when it came to some of these startup projects, it wasn't even just the smaller ones, like even the bigger ones, like the companies like Celsius and BlockFi, where they were getting just crazy valuations, and they were just taking so much risk to basically keep those valuations to generate revenue, right? And that behavior is what kind of got them underwater. Even like companies like Three Arrows Capital, which is essentially a hedge fund. They were investing in anything and everything, and they were what we like to call leverage long to the max, and not believing that there could be any type of a downturn. And as soon as there was just a little bit of a downturn, let alone a big downturn, things started to unfold and kind of deleverage in the way that at least I predicted. And there's a lot of people in the Bitcoin space that seen that coming, with just how much free money was getting put into absolute nonsense, right? And if you wanted to relate it to not even company or venture backed businesses, like you can just look at the space as a whole and look at NFTs, right? Like there's pictures of rocks trading for $300,000-$400,000, and so like there's pretty good signal and indicators out there that there was definitely some froth, to say, in the market, and a lot of these people just couldn't see it, right? Call it FOMO, call it horse blinders, whatever you want to call it. We always get like that, humans, I mean, in these kind of these market cycles where we let our emotions kind of take over and basically kind of fault us. But things really started to unwind November of last year, but realistically, a lot of the things didn't start to unwind until June, when we had that Luna collapse. Well, we have Do Kwon, who's still on the run apparently somewhere on this planet, and them blowing up basically, and then blowing up Three Arrows Capital. And then that blew up all the lenders in the industry, from Genesis to BlockFi to Celsius, because Three Arrows Capital owed them billions and billions of dollars. And going back to risk management, these lending companies did not do proper risk management, where if their biggest borrower in their book went belly up, they weren't able to mitigate that, or basically plan for that. And as soon as their biggest lender kind of went bust, they went bust, and every last one of them needed to be rescued. BlockFi got rescued by FTX. Voyager got rescued by FTX. Genesis got rescued by their parent company by shoring up their balance sheet. Celsius, well, we all know that they're Chapter 11, and that's just in the North American market. That's not even the Asian market or the international market, where there's other companies that kind of went belly up from this as well. But I'll stop it there and see if you have any questions.
No, and actually, it's interesting because you use two words that are often thrown around on social media, which is FOMO and FUD. And you can't have risk management if you don't embrace some of the FUD, right? Some of the fear, uncertainty, and doubt, because risk management ultimately is about sizing, which relates to conviction, and you need to have some doubt about the unknowable tomorrow to at least survive the risk of ruin, right? Which is always a possibility, certainly in a very leveraged space. And you mentioned leverage, and this has always been sort of a major issue for me when I think about the cryptocurrency space, which is that I think you and I would probably agree that it's an asset class that lends itself to narratives, which can be pretty strong. And narratives result in overconfidence. Overconfidence leads to leverage, and then leverage leads to crashes. Now, in public markets, equities, bonds, there are limits to leverage. You don't necessarily have the same degree of limits to leverage when it comes to cryptocurrencies, because they trade globally, and they're not, obviously, it's not uniform regulation around that. So when you think out further in time, how important is it for there to be some degree of regulation around leverage potentially in the space? Because I think if you're going to try to get institutional adoption around digital currencies, you need to temper the volatility. You can't really do that unless you have some degree of normalcy in terms of how much one can risk.
Yeah, no, that's 100% right. And this cycle was predicated, or this cycle's downturn was predicated on what just call a Ponzi, which was basically Terra. And even like, if you want to go ahead and say it wasn't a Ponzi, it was just a malformed, like, theoretical stable coin, which was supposed to be automatic and algorithmic. But at the end of the day, they were trying to keep a stable peg of a token to the USD by backing it by Bitcoin, right? And like if you just that doesn't even pass the sniff test, because how can you keep something pegged and stable to one thing when you're using a different piece of collateral to back it, right? Like they were basically doing or trying to do what other central banks do around the world when it comes to pegging currencies to the US dollar, right? They're using a two-way peg, and where a lot of these central banks hold US treasuries, and if however the free market is rolling, they will either buy US treasuries or sell US treasuries and buy their own or sell their own currency to keep the peg or the peg that they desire of their currency. There's a few nations out there that do this, and that's what in theory that they were trying to do, but they were trying, which makes sense when you're using US treasuries which is denominated in dollars and it is dollars. But then when you try to do that with an asset that's completely unrelated and uncorrelated to said asset you want to keep it pegged to, Bitcoin trying to peg to the US dollar, there is inherent weaknesses and inherent flaws that can be attacked. And it was, right? Like there was the Wall Street hedge funds that basically financially attacked this, as they had probably every right to, and broke the peg, and it all came crashing down. And that kind of set off the real liquidations and the real deleveraging starting in June. But you are right, like the FOMO and these narrative driven things, they really are beholden, or not beholden, but they can really pull people into a spot where they're not doing risk management. And that's like a clear cut example of exactly what happened here.
Right, and obviously, I know you don't speak for the entire community, but I think the thing which has always been problematic for me is I don't find obviously any problem with the inherent technology, but I do find there's a problem in the communication around risk management, conviction, the idea that you should leverage your house to buy Bitcoin, and kind of statements like that, which if you're very wealthy, you can say that, but for everybody else, it's actually quite damaging, because people do want to look to the soothsayer on the hill. They do want to find the way to get rich quick, and oftentimes it hurts them, not those that are actually spewing that kind of narrative. And right. And I will say real quick, I sympathize, and I very much actually just conceptually agree with a lot of the problems that the Bitcoin community often points to when it comes to fiat. I believe there's a different solution to it than a hard currency, which we can talk about. But I do think that there has to be, broadly speaking, whether it's Bitcoin or other cryptocurrency, and we can argue whether it's a cryptocurrency or not, I do think that there does need to be sort of a rethinking of the message, right, from the real leaders in the space.
Yeah, no, exactly. And the biggest distinction I want to make here is there's a huge line in the sand between Bitcoin and everything else. A lot of the problems stem, like there is people in the Bitcoin community that are not very good at marketing when it comes to risk management. They're just like FOMO, buy everything that you can. But a lot of the things that really, I'll even use the word disgust me, comes from the crypto community when it comes to shilling scams or shilling things. Like there's such a broken incentives where people are getting paid to shill things. And no one's actually ever paying for it, right? Like there's so many people that are out there that are just shilling these things that are even so much more dangerous than Bitcoin when it comes to volatility, and they end up just folding in on themselves. And then you see these people don't even take ownership for what they said, let alone actually have consequences for saying things out into the marketplace where they're getting retail investors out there. There's literally hundreds of YouTube channels out there of just these, I'll use the word idiots, just shilling cryptocurrency nonstop and saying, oh, this is going to make you a millionaire. Do this, buy this, sell this. And like these people are getting retail wrecked. Right. So like I think there needs to be a distinction made between like, are people telling people to invest in Bitcoin and do it responsibly? And then you have these other people that are just absolutely recklessly shilling things that are outright scams to people. And then when those scams actually unfold, they're like, well, I told you this wasn't financial advice at the end of my video in 0.1 seconds, or you need to do your own risk management. And like that's my biggest gripe with the whole crypto community is that almost everybody, every on almost every big influencer, they do that, and then they don't actually even take responsibility for when it blows up in their face. And they're like, well, I was shilling this company and they're paying me ad space, and I'm just going to plead ignorance because I didn't do my research on this scam company, and I just shilled it all in my ref links and all these things about this company. But well, it's that was your own decision, that was your fault. So like, I do agree with you. There is a lot of things that need to happen in this space so it can be legitimized. And one of the biggest things, in my opinion, is holding people accountable for what they say.
Right, and part of that is, and this kind of goes into a discussion around regulation, right? Which is, one of the beauties you can argue of the space is that it is unregulated. It's kind of capitalism in its purest form. At the same time, you can't really get rid of the people that are shilling nonsense and fraudulent things unless there are legal consequences, right, to that. Which means you need to have some kind of global regulatory framework, but that has other dilemmas when it comes to thinking about the core of what Bitcoin is supposed to be about, or other parts of the space. How do you think about regulation in the context of that?
So regulation is going to come. The only question is what regulation comes. Like how, like for the problem that I just described, what kind of regulation is going to stop that, right? That is going to be something that I'm assuming would have to be enforced probably by the SEC, and that underlying thing would have to be a securities, right? Because I don't know, because all these people are unlicensed, right? Like even if you're looking at it in an aspect of like the wealth management industry, they're not licensed, so they're not beholden to compliance or regulation on what they can say, as long as they kind of give you that 2 cents. So like it is going to be I'll call it an uphill battle for those type of regulations. Like regulations coming, we can kind of get into that conversation as a whole and what's coming for regulation. But as it contains to like, or pertains to like confining speech, it's really hard. So there's a lot of questions that need to be asked on like what are people going to allow to be shilled on online, like theoretically even on this space, if I was to just start to shill a project, right? So that's a hard question when it comes to that specific problem.
I believe you consider yourself a maxi. I've always thought that term is interesting because, look, you need to have conviction to really be wealthy, right? I don't care if it's being an entrepreneur. You have to have conviction in yourself and you're a business idea. I don't care if it's, somebody that's taking a big bet on an individual investment. And of course, the issue with being a maxi in anything is that you can be wrong, right? I mean, you may not want to, you obviously don't want that to be the case, but part of the idea of having a concentrated bet on something is that there's a chance that you can really make it and become an outlier. There's also a chance of, again, the risk of ruin, right? It's somebody once said in a conference I was at many years ago that diversification is a luxury for the rich, which means the only way to be rich, you can argue, is to have a concentrated bet on something, but that's also the surest way or fastest way to also go broke. How do you think about the term maxi in the context of risk management? Because I think this is really important for people that really do believe in Bitcoin in particular.
So yeah, for sure. So there's a couple of different ways you can look at maxi. You can look at it when it comes to your asset, or I'll just call it your asset allocation for your investing. And then there's maxi in terms of what you think Bitcoin is going to do versus everything else. And I don't mean what it's going to do in terms of making money. I mean in terms of how it's going to change the world, right? Because a lot of the Bitcoin quote unquote maxis are not so much people that are looking at it in terms of like, I'm going to make more money. They're looking at it as Bitcoin is the only digital asset, or call it whatever you want to call it, that can actually potentially separate state from money, right? Because there's two different things when it comes to cryptocurrencies versus Bitcoin. A lot of people that are in the cryptocurrency space and the digital asset space, they're only looking at it as technology. They're looking at it as a way to make money off an investment, a way to start companies, which is fine, but they're not worried or even concerned about basically separating the state from money, right? And what that implies, right? So in Bitcoin, on the other hand, basically it's not a technology play. It's something different, right? And a lot of maxis fall with under that bucket more than, oh, I have conviction that Bitcoin is going to make me the most amount of money. that obviously is a thing because money drives everybody. But they just think that Bitcoin is the only thing that actually has a shot at separating state and money. So there's that. But then the money aspect, yeah, if someone has, let's say, like 90, 100% of their liquid net worth invested in Bitcoin, they obviously think it's going to go up and that they're going to be rewarded for said conviction. But like you said, there is always that risk that you're wrong, whatever you think that percentage is. Obviously, for someone that has 99% of their wealth in Bitcoin, you're going to be pretty sure that they're almost 100% sure that they have a winning horse. So there's both of those things to look at when you talk about conviction.
Yeah, and like I'm a fan of Jeff Booth, who I've had on some of these spaces before, and I think he'd consider himself a maxi too. And I'd asked him, well, how much of your portfolio is in Bitcoin, and he made it a point to say that clearly it's not everything, right? That he's also investing in other places. So it is important to distinguish that one can have deep belief in an investment, but also have a ceiling in terms of how much to invest in it.
Yeah, no, that's one of the things that can also happen that I didn't mention. You can have someone that has that high conviction, but they only have whatever percentage of their net worth in it because of risk management, right? Like we probably could look at someone like Greg Foss. I don't know if you've heard of him. He really likes to refer to Bitcoin as kind of an insurance policy. Like if you only have 5 to 10% of your portfolio in Bitcoin, it doesn't matter because like if Bitcoin does succeed and it is that insurance, that it doesn't matter if you only have 5 or 10%, that like if it ends up winning, that 5 or 10% is going to be 100% of your portfolio eventually, right? And that's like, I know Bitcoin has a very short life and when it comes to basically comparing financial assets, but like if you started with Bitcoin only being 5% of your portfolio, over time that grows unless you do rebalancing, right? Like Bitcoin has been kind of on an upward trajectory for the last, call it 11, 12 years. Obviously, these last 2 years, every single asset on the planet is down. But I can almost assure you that probably some years down the road, Bitcoin's going to make higher highs, right? That's just native to a Keynesian system. If an asset's still around, it's going to be worth more than what it was in the past, just because of all the money printing. But yeah, there's lots of different ways to look at that.
All right, so that's a good transition since she said money printing to the Fed and all this talk of a pivot. And I do believe it relates to Bitcoin because the truth is, like every other asset, Bitcoin has benefited from the money printer going burr. So that's just the reality, right? Everything I've used that point before. It's like the Fed destroyed all stores of value, right? There's no such thing as a store of value because everything has tail risk in a world where you've got heightened liabilities, debt, and then central banks that are trying to manipulate the monster that they created. I'm curious to hear your thoughts on not the idea of a Fed pivot, but when you look at the global landscape, the idea that other central banks could do some of the Fed's dirty work to try and contain this volatility in the bond market. And, we saw that with the UK. I've put out that tweet before that the Bank of England basically bailed out the Fed when they stepped in with gilts. But I'm curious to hear your take on what's going on with monetary policy globally in the context of all of this volatility that we're seeing in the bond market, which I've said many times is the event that everyone's looking for in the stock market.
Yeah, so like you said, you could either look at UK and the guilt, or you can look at Japan even over the last 24 hours, I guess, trying to save their rates or whatever you want to call that. I don't really look at it like these other central banks are kind of bailing the Fed out. They're bailing themselves out, right? Like it's a dog eat dog world out there. Like, and as much as people like to think that all the central banks are kind of all aligned and they're all on the same page, I don't really adhere to that. They obviously communicate, but the Fed is doing what the Fed is doing. And the UK or the Bank of England or the Central Bank of Japan, they're reacting, right? Like they're doing what is in the best interest of them and themselves. And they're just saving their own bacon when they're deploying more capital to save these markets, right? Like if UK let the pension funds explode, well, that wouldn't be a pretty day in the UK, right? And sure, the byproduct is that probably allows the Fed to continue tightening without causing let's call it a global incident. But overall, I think they're just doing it to save themselves more than helping the Fed continue to tighten. The Fed will stop tightening eventually. The question is when. Obviously, I don't think it's this year. I think they'll probably tighten in November and probably December. They'll probably do the 75 bips in November and then probably give forward guidance that the out of the ordinary size of rate hikes have probably come to an end, and that they're going to go back to normal rate hikes. And you'll probably see 25 in December and then maybe another 25 next year. But the rate hikes are coming to an end. The only question is, it's not so much when they pivot, because like everyone has this like, oh, as soon as the Fed pivots, the markets are going to turn around and V-bound basically like they did out of COVID. But I don't think that's what this is going to be this time around. I think they're more likely going to just, whenever they hit the terminal rate or the neutral rate or whatever they want to call it when they stop tightening, I think they're going to hold it there for some time before they even start cutting. So you'll see the psychology in the market of when the Fed basically stops tightening, that you'll probably see bounce in equities. But I don't think you're going to see a V-shaped recovery. I don't think they're going to go from like the biggest tightening that they've ever done in history when it comes to percentages and how fast they've done it to then just cutting rapidly again. But I could be wrong, right? Like if there is some type of financial crisis where that needs to happen, they're going to do it. But the question is that going to happen and when is it going to happen?
No, I think that's an important point. I want to riff on that, but just before I do, for the remaining half hour here, everybody here, please make sure you follow Magoo, PhD Hodel Magoo here on Twitter. As you can tell, quite thoughtful in the way that he thinks about markets, and certainly appreciate those that are here. So I've been on this melt up kick since October 2nd, and talking about it from the standpoint of conditions are there, sentiment is incredibly one sided, leading indicators are all turning, and I keep using that line that opportunity always exists when the crowd thinks it knows an unknowable future. And it's funny to me because people see my content and my interviews and they seemingly can't understand that I say that from a standpoint of humility because I've been humbled many times in my life. And I know that nobody knows what tomorrow brings, but I do know where the pot is that fewer people are betting on, right? Which is that you could have sort of a shock move higher. Now, I want to hear your thoughts on this. I've made this point that I think there are two, let's call them tail risks. Tail risk number one, which is the most immediate one, is the quote unquote end of the world, meaning bond market volatility continues from these already elevated rates, yields really super spike, in which case, if you were to extrapolate out the speed with which 30-year Treasury bonds have moved just in the last 3 weeks, you talk about 30-year mortgage rates at like 20% next month. That sounds like an end of the world thing if it doesn't abate soon. So immediate risk is you got to contain at least the speed of that, and seems like central banks are starting to be aware that this is now potentially a real serious issue. The other tail risk, once that's resolved, and I believe at some point it will be, is the sort of traditional tail risk that you see in risk assets, because the reality is the damage is done, and you're going to have a recession because these bond yields, to your point, are probably going to stay elevated, at least on average, over time. How much time do you think it'll take for things to quote unquote normalize? And I know that's a loaded term because it's like, what the hell is normalization when you have so much government debt? But if you're going to say to yourself, okay, I'm going to choose a time to sleep and wake up at in the future, at what point do you think we'll be out of this?
I don't think we're going to be out of this until probably the end of the decade, because I think the Fed is going to be teeter-tottering between high inflation and yields that could potentially cause havoc for, let's call it, the governments or sovereigns around the world to kind of maintain in their debt levels. Because we're at these debt levels that are so high, like debt to GDP ratios around the world are just so high where, like, realistically at this point, I think the US government is paying over $1 trillion. I think it's like the second or third biggest expenditure on their budget is just interest, right? And so, like, you do have that like hard stop where they can't raise rates to a point where all the US governments and all the sovereigns will just be paying interest and nothing else. But they're in this kind of like teeter-totter moment where I think we're going to be going through a decade long of like heightened inflation versus like these deflationary bust periods. And you're going to see the Fed basically be reactionary, as they are a reactionary institution, where they're in a never-ending game of catch-up, trying to keep up with inflation and then trying to save the markets when deflation comes about or disinflation comes about. And the name of the game is always making sure that the inflation rate is actually higher than, just call it, the Fed funds rate, for lack of a better words, right? Because that's how these central banks are able to dig themselves out of the hole that they're in, is by burning away their debt, by inflating it away, and basically taking that out of the pockets of the people that hold said currency, right? And we get into these psychological moments where, like, everyone finally realizes that inflation's here, and they demand that their politicians do everything. And so now the Fed is saving face by saying that they're fighting inflation and they're going to fight it, and then they're going to send us into a recession, and then the people are going to demand more money printing. And it's all about keeping, like, the expectations and the reality around, like, the populace's, in my opinion, the populace's thought process. Because if you can keep this teeter totter going, you're not going to have this massive demand for the population telling the politicians and the central bankers that they need to do something, because they are going to be doing something, but they're going to be in a game of catch up. And if they can keep, the Fed wants to keep basically the inflation rate higher than the interest that they're paying. And I think that's going to happen for quite some time. So you're going to see this, like, up and down, up and down. I think this entire decade, where inflation is higher, baseline higher than where it was last decade. Decade it was like pegged at, I don't want to say 0%, but it was between 1% and 2% usually over the last 10 years. But I think this decade you're going to see the rate substantially higher than that. So, like, I don't know what you want. Like you said, it's a loaded question, so it really depends on what you want to call normal, right? Like, get back to a normal state. Like, what in your opinion is a normal state?
I mean, for me, normalization means debt levels decrease. So here's the issue that I have with this inflation, negative real rate idea, that you need inflation to resolve all this debt. The implicit assumption there is that spending will not increase at a pace faster than inflation, right? Because if your spending increases faster than inflation on the government side, it doesn't matter what the inflation is doing, because you're still adding more on a real basis after inflation, right? So, and I shared at the top of the tweet here this Peterson Foundation point. They predicted, and who knows about predictions, right? But U.S. government will incur $66 trillion in interest payments over the next 3 decades, consuming 40% of all federal revenue during that period. And I only say that because, speaking about narratives, there is this narrative, as you know, that we saw we're at the end of the 40-year bond bull market. I have a problem with that narrative, because you can't really end the bond bull market unless you end the spending bull market, right? That unless you do that, you can't really normalize anything.
No, that's right. But on the other hand, like, it's going to be, GDP, I think, is going to be muted theoretically over the next 10 years as well, because we're entering this period. Like, if the world continues to go the way it's going, with its we hit peak globalization in like 2014 or whatever that was, and now we're in this rapidly evolving, like, deglobalizing economy, where we're seeing the fracturing of, I'll call it, trade federations. You're seeing China and India and Russia separate away from the West, and the West is solidifying basically their trade lines. And that is inherently going to be rather inflationary. And it's going to be very hard to have GDP. It's not impossible, but it's going to be harder to have GDP above where the inflation rate actually is, just because of how much deglobalization is happening and going to happen over the next 10 years. It's not going to get any better. You're not going to see Russia end the war overnight and they're come back into, like, the hovering arms of the West. China is exactly like that. It's only going to get worse. India is probably going to only get worse when it comes to who they're doing trade with, and what we want to do for trade, and what manufacturing we want to have offshore versus onshoring, things that come down to national security, that we learned over COVID, that having our entire manufacturing base, or call it your chips in Taiwan, your PPE in China, they learned a pretty important lesson, that when you have that stuff offshore, there's a huge national security risk. And so I think we're in this period of deglobalization that's really going to hamper the growth of GDP, which is really going to limit how much money they can print and how much money they can spend without even blowing out these debt to GDP ratios even further. So I think it's going to be a while before that normalizes, right? It's like the closest period that I can even relate to. Like everyone likes to point to a period in time in history, what is kind of most like in today's situation. The answer is there isn't one. Today's situation is very unique. The closest thing I can resemble it to is probably the 1940s. But even then, there's some things that are completely different that even makes it harder for them to normalize this time around. So I don't think it's going to be an easy go at them normalizing around, because even on the political side, you have endless amounts of politicians who basically their career thrives off giving free handouts, right? Like their whole careers are basically deficit spending, where now we have, I don't even know how much unfunded liabilities the United States government has, but it's in the trillions, like the tens of trillions, if not more than that, dollars. And so it's going to be really hard for them to even tighten the belt buckle, right? And you see Biden saying, oh, we've reduced the deficit or the budget by the biggest amount that it ever has. It's like, well, you're comparing it to blowing out the deficit in the budget from COVID, right? So, like, they're going to have a really hard time really reining in spending, which is going to have a really hard time reining in inflation with all the other things I just mentioned. So I think it's not going to be an easy go at normalizing, in my opinion.
Yeah, and I think one of the estimates I saw was that there's like 170 trillion of unfunded liabilities. So that's why, to me, it seems to be impossible that you can have a super cycle of higher interest rates. And it's important to note also that politicians get elected based on nominal growth, right? Real is a whole different animal, right? You can have nominal growth that's positive, real growth that's negative, but to voters who are susceptible to money illusion, right, from a behavioral finance perspective, they're not going to be able to tell the difference.
Yeah, exactly. They're not going to be able to tell the difference until it's in their face, right? Like where the standard of living goes down and where the cost of living goes up, right? And that's the only reason why a lot of people were affected this time around, is because it was in their face. It was not just in the financial asset, like in the great financial crisis where inflation was only seen in the financial assets. It was seen on the dinner table in different places. So it is, yeah, this idea that we're going to be at these higher terminal rates for a long period of time, I think is silly, because exactly what you just said, the governments cannot even manage their debts at these levels. And realistically, it's not a question of if they're going to pivot and if ZERP is going to come back, because ZERP is most certainly going to come back. The question is when it can come back, right? Because you can pretend that you're tapering a Ponzi in the short term, and that's what the Fed's doing right now. But in the long run, you can't taper a Ponzi. You have to continuously print, right? Like that's kind of like how I equate Keynesian economics. It is a Ponzi, and I don't mean that in like a negative sense, but it is a Ponzi that requires even more money growth than day after tomorrow through in perpetuity. So they have to continue to print and print even more. And with the rates where they are, even are right now, that becomes unpayable, where they just can't do it.
And by the way, I'm with you on that point. I've used that line before. Debt is deflationary when you can't issue more of it. The implication there, of course, is that debt is inflationary because you can keep on rolling it over. As long as you keep doing that, that's the Ponzi, right? To pay off old debts with new
Yeah,
debt, right? So,
exactly. Yeah.
right, and I think that's what's also missed in a lot of this discussion around debt loads, right? So that's good. This goes actually to the final, name part of the space, right, which is the end of the world. So I've made this point, and obviously I've been, I believe, early, not wrong, but we'll see with the fullness of time, that the speed with which rates have risen is actually more of a deflationary shock than anything else, because at the end of the day, speed is what drives inflation expectations, not necessarily level. We haven't seen that yet because there's lags, obviously, in terms of interest rate movement and the real economy. But what's your take on this? Do you think that all this is going to resolve itself? Because you kind of allude to this sort of deflationary bust, these moments where you get some real concern over liabilities, and then they reflate, and then basically the amplitude just gets bigger, right, in terms of the
Yeah.
swings.
Yeah. So, like, ultimately, the Fed is going to choose inflation over a depression. Like, that's what I say. The only thing is, at what point are they going to choose at? Like unemployment at 3.5% and year over year inflation's at 8.2. I don't think the Fed pivots here, right? You could see that unemployment number jump radically over the next couple months, and that inflation year over year number drop to quite a bit, right? Where they might give them more wiggle room to pivot, but right now I just don't think it's realistic. But ultimately, they will pivot, because if they don't pivot, it basically means a global depression, right? Like, and I don't want to throw the big D word around, like just to kind of give the shock value. But if the Fed does continue to raise, like there's only a point in time until like everything, like liquidity dries up in the treasury market, and like you say, like that's the end of the world. That's the monetary system falling apart. And if the monetary system implodes like that, like you're going to be more worried about how many bullets are in your gun than what's in your portfolio, essentially, right? And that's the end of the world thesis, right? If I'm not mistaken.
Yeah, I mean, which sounds really dramatic, but this is the one time out of 20 where treasuries have, from a sequence interaction, not only done worse than stocks in a drawdown for stocks, but even in terms of the way that's played out, it's very abnormal pathwise compared to history. And people always keep on going back to this idea that, oh, it was in a clear bubble, so sure, this was to be expected. But I always go back to path matters more than prediction. So to me, if this continues, given how much debt there is, in terms of the volatility, not in terms of the level, in terms of the speed, that is a system reset, right? So, and that's why the core, and I've seen this many times where it's like people want to bet against equities, but the implication of their bet against equities is something far more nefarious than people realize. I remember back in '08, I'll give you an example. A lot of people were trading the VIX ETN, VXX, which is, back then, an exchange traded note issued by Credit Suisse and a bunch of other banks. And I remember in the depths of the financial crisis in '08, people were screaming on message boards, you got to buy VXX, the whole world's ending, you got to buy VXX. And I would look at these people and it would drive me crazy, because it's like they're saying to buy VXX to play volatility on an end of the world type of bet. Meanwhile, it's an unsecured debt obligation. It's an exchange traded note. So the end of the world wouldn't allow you to even make money off of that bet. So to me, I think there's a lot of corollaries that I can see and make an argument for in terms of today. And that's why, if it's the end of the world, you might as well be bullish on stocks, at least for a moment in time. I don't believe the bear market's going to be over for a while, right? Because to your point, this is going to be a very long, messy process. The housing bear market's just getting started. But people seemingly forget that bear markets have these 20, 30% rips in risk assets. By the way, that would also include Bitcoin.
Yeah, no, 100%. Like you see those biggest rips actually happen in bear markets, and you could see here, if the GDP number actually prints positive. I don't know if you trust GDP now, but if that number actually prints positive, I could see a narrative of a pretty big bear market rally in risk assets here in the end of the year. But a little bit longer term, like you said, we're kind of just starting this bear market. They haven't even declared it a recession, basically because of corporate earnings and unemployment being so good, opposed to the two consecutive quarters of negative GDP growth being a recession. They're not calling it a recession. So like, and we haven't even really seen corporate earnings really start to draw down in terms of really surprising to the downside. Like they're starting to, but I think that's going to accelerate. And there is, in these bear markets, where like if any good news comes out, you could see some pretty big rips. Now, the length of this bear market in entirety, that's harder to call. Like I think that probably the Fed will probably pivot eventually in Q1. The question is, like, do you think a pivot is stopping hiking, or do you say that a pivot is cutting rates, right?
So hold on. So that's actually a good point, because everyone says pivot, but I don't know if people are defining what a pivot really is. I think most are assuming it means they cut rates, but a pivot can simply be a slowing down, right?
Yeah.
Which goes back to the containment of the volatility, right? If you're going to have a melt up in stocks, you have to cut off the tail risk of the free fall in bond prices, in particular treasuries. So if you slow down the pace, if the Fed does what it normally does, which is instead of acting differently, just speaking differently, that's enough.
Yep. No, exactly. That could be that tail, like the psychology where everyone doesn't have that tail risk anymore, and like, okay, now we can go long here, and do that for the short term at least. And so I think the pivot, as the way that you describe it, will probably happen probably early next year, probably even as early as January, probably, but most likely later February. I think if I had to put an exact month on the pivot, it'd probably be February. And then when it comes to actually cutting rates, well, if you just look at like kind of like the euro dollar futures markets and where they're kind of pricing that at, it looks like they're saying they're going to start cutting rates in June of next year. But realistically, if you want to look at it in a lens of equities, the equities usually bottom, what was it, 6 months before unemployment peaks, if I'm not mistaken. And so as equities are risk assets. Risk assets will bottom first, and probably unemployment will peak last, and real estate will probably bottom last, like it always has. When that happens is a better question, I think. But it really depends on how you're trying to play this market in this dynamic of Fed pivoting, not pivoting, when they pivot, and what you're kind of looking to invest in. So let's take an example for what was money before fiat money. Let's look at gold, right? And you can say gold is money, whether it was issued by the private sector or if it was issued by the government in terms of coinage. Gold was money. And as we started moving into this digital age where we needed instant finality and instant liquidity and being able to transmit it basically around the world without actually having to ship tons and tons of gold around the world, they came out with computers, right? Like first they came out with paper currencies and those were easily transportable, et cetera, et cetera. But it really accelerated when computers were invented, and where they just started using ones and zeros essentially to be that money and be that network of transmission. And that's where gold kind of failed at what it was supposed to be. It was supposed to be a store of value or the money of the world. But as soon as the digital age came about, gold really started showing its weaknesses. And then they're like, okay, let's paperize gold and let's token, not tokenize it, but let's what's the word I'm looking for here? But let's make paper gold contracts and futures. And then you have these futures that are basically in regulated markets where you don't actually have to settle gold futures in gold. You settle it in dollars, right? And having the lack of finality of actual the bullion in the settlement network of gold, and you're having to ship it, it basically lends itself to being co-opted by these paper markets. And I think that's what we've seen. And that's where Bitcoin differs, where you have this network, you have Bitcoin the asset and Bitcoin the network, and where you can actually use Bitcoin in a self-sovereign way to transmit it anywhere on the planet instantaneously and have that finality and also that settlement where you're not going to be as more acceptable to basically being co-opted with paper markets. So like that's what I think the Bitcoin network brings to the table in terms of being able to deliver the true separation of money and state.
I'm curious, maybe for the last few minutes here, again, everybody, please make sure you follow Magoo. As you can tell, very thoughtful and certainly knows how to communicate properly complex topics here. I made this quasi joke, but it's really not a joke before that. Had Bitcoin City been fully operational in the period where wheat prices were spiking, corn was spiking, all this stuff, you would have had like mass starvation, right? Because it kind of goes back to the volatility of dynamics make it challenging, right? At least for now. And I know people will argue, and maybe they'll be right, that volatility dynamics will drop over time. But what is it? Is there really a plausible scenario where a set currency like a Bitcoin or digital currency could be adopted by governments and not have the risks of tail events from volatility impacting basic needs? Like I think what ended up somewhat being the case with El Salvador.
Yeah, so if they went on like a full, let's call it a full Bitcoin standard, what El Salvador was planning, it really, the only way that you could ever do that is like you have to shift your mind from basically thinking in a Keynesian mindset and having to shift away from that. Because you're right, if a government has shifts to a Bitcoin only and they run deficits, that doesn't work, because you need something to make up for those deficits. Like in the US, we have all these deficits that we just print money and we have these deficit. But if you have a deficit where you can't actually issue the currency, well then you have a problem. It forces said nation to need to actually run a surplus and actually make money, right? And you're thinking like, how crazy of a thought is that, where a government can actually make money instead of lose money, right? But right now in the current system, they're incentivized to lose money, right? Like, especially in the US, like the US just exports inflation, right? Like the US needs to have a trade deficit so the rest of the world can have money, right? Like that's what we produce is money. But if El Salvador were to adopt like a Bitcoin only standard and they're in a deficit, that wouldn't go too well, right? And if you want to say, even if they're in like a surplus and everything's going fine, and then you have some event, some exogenous event, whether you call it COVID or something, where they need to dampen volatility by printing money, right? Like the volatility gets dampened in the front run, but then now you're seeing with COVID, they printed all this money with COVID, and people thought that there's no consequences. We're just seeing the consequences now, right? Sure, you can probably argue that the volatility is going to be less on the back end than it would have been on the front end if the US government didn't just print trillions and trillions of dollars. But I think that the transition, a lot of people, when they talk about a transition from basically going from like a state currency in a fiat currency to like a Bitcoin or a Bitcoin standard, they're only framing it in their mind in the current way that the world works. And they're only framing it in the next few years and only can imagining it in the current context. But realistically, I think if that ever does happen, I think it's something that's going to be potentially 50, 60, 70, 80, maybe even 100, 150 years out, right? Because you can't, like the way that the entire world economy is on I'll call it an IV, a life IV from money printing. If you just pull that away like cold turkey, the world implodes, or the world economies implode, right? So I think it's going to be a gradual transition over many decades. And like for a country to go full cold turkey and go onto a Bitcoin standard, it's especially an emerging market like that who directly relies on injection of money into their economy from whether it's tourism, remittance payments, or whatever. I think it's very dangerous. And actually, if you knew what was happening in El Salvador, they're talking about creating a digital peso that is their own fiat currency. So like the I don't think they ever had the idea of going Bitcoin only. Like I think that they were using it and using it to get money injected into their country, which was smart of them, where they can cater to the Bitcoiners and the people of this crowd, and they can reduce fees for remittances. It makes sense, but I don't think they ever had the idea to go Bitcoin only.
Yeah, no, very interesting take, and I think we should definitely do a follow up on that point. Everybody here, again, please make sure you follow Magoo here. This was a really good conversation. I never quite know what I'm going to get with accounts that are anonymous, but like I said, I had some really good back and forth DMs with Magoo here. So please make sure you follow him, and appreciate those that are supportive, look beyond tweets, and actually listen, get out of their echo chambers, and are supportive of this tremendous effort that I try to do every single day. So thank everybody. Thank you, Magoo, and enjoy the rest of your day, everybody. Cheers.